returning due to easing of restrictions, we expect the momentum to gradually pick up in the next few months in the Indian market. Specialty sales stood at rupees 318 crore as compared to rupees 240 crore for the previous year, same quarter, up 32% year-on-year. Non-specialty sales for the quarter stood at rupees 135 crore as compared to rupees 101 crore for the same period last year, up by 33%. Gross margin for the quarter stood at 47.1% as compared to 43.9% for the same period last year. There have been sharp increases in the intermediate prices going into the various pigment chemistries. We have passed on majority of the cost increases to the customers. However, we continue to see price pressure on select intermediates, and this is likely to continue for next few months. Apart from the raw material cost increases, we see energy and logistic costs also rising. Increase of over 50% in the coal prices is pushing up the manufacturing cost. The challenges in the logistic area are continuing, leading to the freight cost escalation of over 50 to 60%, and there is also a problem with the container availability. Unlike in the immediately preceding year, we have given annual increment effective April this year. This has also been the practice we followed before pandemic. Please note that the Q1FY21 did not have any increment impact effect as it was rolled out from October 20. Two revisions are now reflecting in the employee cost for this quarter. Salary revisions along with onboarding of resources in various roles during the previous year is leading to higher employee benefit expenses. Q1FY21 had export benefits from MEIS. Road test scheme was implemented from Jan 21. We keenly await details on the rates under road test scheme and currently have not accrued any income. All these factors together have led to EBITDA margin of 14.5% for the quarter. Now coming to the capex projects under commissioning. Despite temporary disruption during Wave 2, we are on track for completion of capex under execution during the current fiscal year. We expect to complete capex project worth rupees 120 crore by end of September. Our manufacturing plants continued to operate in line with various directives of the government during the last quarter, and we continue to deploy and practice necessary safety precautions regularly to ensure continuity and uninterrupted functioning of our plants, with safety and welfare of our employees being of utmost importance. We look forward to continuing our growth journey and delivering value to all our stakeholders. With this now, we open the floor for questions and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Ashwini Agarwal from Ashmore Investments. Please go ahead.
Hi, good afternoon, everyone. Thank you for this opportunity. Could you just help us understand what happened in that subsidiary which caused a loss of 4 crores? You briefly mentioned it in your opening comments, but can you just give some more color to it, and what should one expect going ahead?
Hi, Ashwini. Nilkant here. You are able to hear me?
Yeah, I'm here. I can hear you. Yeah.
So on the subsidiary part, as you are aware that this company is into the engineering business, so it is a capital goods industry, and due to the Q1, partial lockdowns in the various states, they were not able to scale up the revenue. It is not on the order balance or backlog side issue. it is more on the execution because there were lockdowns. And due to this, the revenue has been, lower than what we have expected. But we expect this subsidiary to, make up this lost revenue for the Q1 based on the execution in the coming quarters, and they will be able to be profitable from the coming quarters.
So if I adjust for this 4 crores, then on a consol basis, your EBITDA margin declined by about 100 basis points. And there you mentioned that you have like 2 salary increases and you have the MEIS, benefit going away as well. And your gross margin actually expanded, on both on a year-on-year and a quarter-on-quarter basis, despite input cost pressures. So is this a fair thing to say that, look, if your subsidiary kind of comes back in the coming quarters and let's say MEIS gets restored as RODTEP, in some form or the other, then we should expect your EBITDA margins to expand as compared to what we saw for the full year last year? Would that be a fair expectation if these two things were to happen?
One second. I think so. Very fair point, and we agree with you in terms of our segment. EBITDA has been 14.5%, wherein there has been a MEIS impact and all that. What we also see, there has been a cost pressure, and costs are increasing, whether it is a coal cost, whether it is a freight cost. So, and this trend we expect will continue. So we expect that the margins will be under pressure, and we are continuing to monitor this and try to improve.
Right. On the subsidiary, could you broadly provide the EBITDA number? I mean, it comes to minus 4 crores if I just take the pigments and the consolidated. I'm just wondering, is there anything else there, or that should be the gap for the subsidiary?
Yeah, this is a gap. It is small, subsidy. So the 4 crore, around 4 crore is the gap.
Okay. All right. Thank you so much. All the best, and I'll come back in the queue.
Thank you.
Thank you. Next question is from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Good afternoon, sir, and thanks for the opportunity. I got a couple of questions. First, on the cost inflation, both on the...
Sanjesh, sorry to interrupt you. May I request you to speak a little louder?
Is it good now?
Thank you, sir.
Okay. Twofold question, both on the cost side. The one on the raw material inflation, we said that we have passed some raw material inflation, but we continue to see some of the raw material prices going up. Is it fair to assume that in the medium term, until the raw materials settle, there could be a volatility in the gross profit margins in the next few quarters, and this 43.6% can come down for a quarter or so before it goes up? Is it a fair assumption? And second, on the coal and freight cost, because the other expenses have gone up by have declined by only 1.5%, while our revenue decline is close to 17-18% on the quarter-on-quarter basis. So, is the on the other expense side, is the fuel and the freight the only reason? Because generally from Q4 to Q1 we see a decline that has been an historical trend for us, and this time it has been flattish. Is there anything more in the cost we need to understand, or it's just the fuel and freight which is causing this high other expenses? So these are the two questions on the cost. Hello?
Hey, hi, Nilkant here. So
Yep.
I will answer the first question. So yes, what we have also said that there is the raw material escalation we are seeing, and there are many intermediates where the prices are going up. So rightly pointed out by you, we expect this pressure or variability will be there for the short term. In terms of the other expenses, yes, there has been a reduction, not in line with what you have mentioned in terms of the sales revenue drop. But the major cost increase which are coming is from the coal as well as, the freight. There are no one-timer aspects in this particular cost. So we continue to monitor this closely.
Got it. Second, on the product launches, in the Q4 call, we mentioned that September we were looking to launch a couple of products. So just wanted to understand the new product launches pipeline, and because of this COVID thing, is there any changes in the product launches we were anticipating? And can you just elaborate on what are the product launches planned for this year and a year after this?
Hi, this is Rajesh here. I think you're right. I mean, most of our product launches were planned for September. However, we still expect some launches to happen in September, but April, May, as you're aware, a lot of capex has got delayed because of lack of availability of oxygen and also manpower. So some capexes will get spilled over on the Q3. But by Q3, and we expect most of our product capexes to be completed and product launches to be completed.
So can you give some color on the number of products we are looking at, and whether it's in a specialty, non-specialty, whether it will be export oriented?
So I think they are all specialties, and we expect, if you look at color group wise, maybe three product lines mainly, but in that obviously each product line will have 10-15 products.
Okay. So 3 product line, and each product line with 10 to 15 kind of a product in it is what we are trying to launch. This all should happen in this fiscal year, right?
Yes, absolutely, sir.
And it's a commercial launch, not that we are sending this for client approval and all. This will be
for commercial launch this year. All that is in process, so it will be a commercial launch this financial year.
Okay. That's helpful. One last bit of question, more of a bookkeeping question on the Mahad facility, which we shut due to the reasons we know, that's heavy rainfall. So can you just brief what was the impact and how should we look at Q2 on backdrop of this shutdown of facility?
So you're not audible.
Hey, hi, Nilkant here. So, yes, on the Mahad, Mahad flood, our facility was not operational for 2 weeks. After 22nd of July, we have resumed the operation since yesterday. So there was a 2 week, production loss, and the operation has started from yesterday.
So do we also expect sales loss, or we had an enough inventory and we could manage it through ROHA, or this 2 week of production loss will also mean we would have lost certain revenue?
Sure, yes, we did. Obviously, there was a production loss as those lines were running full. So there was a production loss. There was a sales loss.
Got it, sir. Thank you very much for all the clarification, and best of luck for future orders.
Yeah.
Thank you. The next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. So first question on, the revenue growth here. Now, given the low base, we are looking at a strong growth year-on-year. But if I look at H2 average, let's say Q3, Q4 average run rate, both on the domestic and exports, there is a pretty significant decline on the domestic side as well as, a subdued growth on the export side. The reason I'm taking Q3, Q4 is when sort of, COVID-led impact was easing out there, both in the international and domestic market. So your comments there, a mid-20s, more like, 24-25% decline on domestic, was it largely led by the plastics and ink segment, which you highlighted, in your initial comments? And more importantly, on the export side, if we are seeing any softening of demand there.
So basically, I think there are 2-3 factors. Domestic, as Nakuji has elaborated in a statement, domestic because April, May, and part of June also we did because of the COVID lockdown. We did feel, we saw a lot of demand, which was, demand was an issue. In addition to this, in the plastic industry, there was polymer availability issue, pricing issues, etc., which kind of caused the domestic market to be, or India market to be a concern. In terms of exports in general, I think the trend is good. If you look at Q3 last year, there was some pent-up demand as supplies were an issue in the first half, right? So I think going forward, I think barring a little bit of logistics issues which we are facing some on the export front, we should be able to keep up the export, and we see the sales picking up in Q2 for domestic too.
Sure. And sir, on the revenue growth side, given most of the products may get sort of spilled over to maybe Q3, Q4 launch, but FY23 will see a significant benefit of all these product launches there. Will it be fair to assume that unlike our last, let's say, 4 or 5 year average of 12-13% early teens revenue CAGR, we should look at a reasonably higher number there, incremental contribution from these top products being there. Will that be a right assessment?
Yes, sir. The capex should definitely give us a boost in our revenue growth. However, like we've been saying, the realization of the full potential of the capex should be over 3 years. But of course, revenue growth will start as soon as our some of the capexes go live.
Sure, that's helpful. And just, sir, one last clarification. On the freight cost side, now, as I understand, the logistics cost being higher year on year, but these costs will be effectively passed through to the customers, or do we take it on our books?
It's a little, some of these indirect raw material costs is easier to pass on. First time we've experienced such a high cost on the indirect items like coal and freight, right? So, which we are making, there is a lag, but we are making attempts to pass it on. But that's the area of concerns.
Sure, but if I got you right, there will be a lag in passing through this, but it will be passed on as well, maybe by a couple of months.
Yes, lag by a quarter, I would say.
Okay. That's helpful, sir. Thank you and all the best.
Thank you. The next question is from the line of Rohit Nagraj from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. So the first question is in terms of the capex. So you mentioned that about 150 crores will be commissioned by September. What is the timeline for the next 2 years in terms of the incremental capex? When is it likely to get commissioned to understand how the revenue profile probably would look for the next 3 to 4 years? Thank you.
Sir, Nilkant here, I would like to clarify. What I said in my opening remarks is 120 crores by September end, not 150.
My apologies, sorry.
Can you please repeat the question? There was some lag in between.
Yeah, so this 120 crores will be commissioned by September. For the rest of the projects, how do they look like over the next FY23 and FY24 in terms of commissioning?
So the balance capex project we will be completing in Q3, not in FY23. So we will complete all this capex project in the current year itself.
Okay, sorry, I think I may have asked the wrong question. So just to understand, 120 crores will be commissioned by September. And are there any other capital work in progress which will get commissioned in subsequent quarters and in FY23?
Yes, sir. Thank you. Balance will get balance capex, capital WIP will get commissioned in Q3. Correct. So we said around 300 plus crore in our earlier presentation in Q4. So 120 crore will get commissioned by Q2. Balance around 180 to 200 crore will get commissioned in Q3.
Right. Thanks. That was helpful. So the second question is in terms of the orders. So we have seen that last year, because of the validation getting postponed due to COVID issues, we have got, the new product launches have got delayed. So are we facing such delays still because of the second wave and the ongoing, probably impact of the third wave, so that the product launches would further get delayed and may hamper our revenue profile despite being, good in terms of the capex being commissioned? Thank you.
Sir, as this is Rajesh here, Nathuji mentioned that the capexes, are because of the Q1 issues we had, the capexes did get slightly delayed, but the team has done a great job in making up some of this, and we expect for any unforeseen reason, anything not to happen, we should complete everything by Q3. And the commercialization also should happen after that on speed. Yeah.
All right. Thanks a lot and best of luck, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Archit Joshi from Dolat Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. So my question is largely related to the mica-based pigments piece that we have in the business. I believe we have recently got some anti-dumping duty in the month of June for some of the products under that category. So I just wanted to, ask you if you can throw some light on what is the strategy that we are having on that front, what kind of benefits we might accrue from this ADD, and where are we in terms of, any product launches or any capital expenditure on that part. So just a broad understanding on how that business unit is panning out for us. Thank you.
Hi, Nilkant here. So currently, proposal is pending with Ministry of Finance, and we are awaiting the result. Okay, so we will await for that, and then notification, and then we will see.
Sure, sir. But sir, even otherwise, without considering the anti-dumping duty impact, which we probably might have clarification on later, how is the business on that front? I mean, I'm supposing that the margin profile of that particular piece, even if it is smaller in terms of the current capacity that we have, it's fairly higher than the blended margins that we are having in the other HPPs and some of the other pigments. Any thoughts on that front? How are we trying to ramp that up, and how is the demand panning out in that particular smaller piece, even if it is right now?
So, majority of the market on the industrial side, we don't participate in a big way because of the dumping from China into the India market, and that's the reason I think the government is looking at protection for this. As soon as we are able to get that, we will be able to participate in that market. The margin profiles are not very different on those businesses.
Right, sir. And sir, for the same product, how is it faring on the export side? Is the growth momentum, if you can comment something on that as well?
That product range, so on the industrial side, we don't participate in the global market because we sell more into the other markets, the automotive and cosmetics market.
Right, sir. Okay. Thank you, sir. Thanks, sir.
Thank you. The next question is from the line of Dhaval Shah from Girik Capital. Please go ahead.
Hello.
Go ahead, sir. You're audible.
Yes. Sir, just one broad level question. So the global level consolidation which you have spoken about between the top 2-3 players, how do you see helping us? And also, has there any capacity which is completely gone out, or there has been or there is a consolidation, so it's not gone out of the global demand and supply?
None of the capacities have gone out. It's just consolidation, and we expect since the number 1 and number 3 players become one, and maybe the number 2 and number 5 people become one. We expect two areas. One is that customers are looking for alternatives, and also some of the China crisis. India does look like a good alternative, and that's where we are acting on the favorable sides towards us.
So how much capacity, if you can quantify, which has got out of the market, and in which category it is?
No capacity has got out of the market.
Okay, it's not gone out of the market. Okay, but we see opportunity in which any specific product segment where we see a lot of opportunity because of this.
We see in all the organic segments. On
the organic side. Okay, so that's where all the majors are largely present, the top 3. Okay. And our focus will be also more on the cosmetic side going forward when we say about more complex or a specialty pigment.
No, not really, sir. It's coatings, plastics is our major focus.
Coatings and plastic. Okay, fair enough, sir. Thank you.
Thank you. The next question is from the line of Naushad Chaudhary from Systematix Group. Please go ahead.
Yeah, hi. Thanks for the opportunity. 2-3 questions. Firstly, on in pigment business, I just wanted to understand from the client point of view how important it is for them, to have a balance. Suppliers wallet share, or the concentration is okay from the client point of view? Yeah, that's my first question.
So I think from a client.
This call is now being recorded.
From a client perspective, they do look at usually. There would be 2 suppliers at least, generally a 2-supplier position.
Okay. And secondly, in terms of raw material supply and availability, if you look back 3-4 years back versus now, do you see has there been any changes in terms of number of suppliers or availability? Has there been any change in terms of overall ecosystem?
There have been several issues from China and the perspective of raw materials, and that's where we are seeing a lot of increase in cost in raw materials.
Okay. And have we seen any domestic capacity addition on those parts and some softness and easiness in terms of availability?
There has been some additions in India, but it's not enough to meet the industry demand.
Okay. And lastly, on the capex part, during FY21 and 22, whatever we have planned, can we broadly split between how much we are spending in our classic, also Thylo, HPP, and backward integration, broadly in terms of percentage, if you can split it?
So it's a little bit competitively sensitive information, SKU-wise, so that's why we don't split that in the product line perspective.
All right. Thank you, sir. Thank you so much.
Thank you. The next question is from the line of Amar Maurya from AlfAccurate Advisors. Please go ahead.
Yeah. So thanks a lot for the opportunity. So a couple of questions. Firstly, as you indicated that, the domestic business which got impacted is largely linked to the plastic coatings and the printing business. And so what percentage of the overall domestic revenue would be linked to this particular industry?
That'd be the large part, sir. They're the three main industries we serve.
Okay. And now you see the bounce and you expect the run rate to come back to the normal level?
So I'm not sure whether we should see a normal uptake, but I'm not sure whether we'll be able to make up the what is sold.
Okay. And similarly, sir, in terms of the export, as you indicated that the new capacities and new products which are going to come in the second half largely. But I believe our capex or the capacities which had come to the last year, like yellow pigments and all, those will give the good ramp up in the second half, right?
Sir, I think partly the major launch was the yellow pigment, and that yellow pigment mainly goes into coatings, which takes a little longer to kind of get the approvals. And as we had mentioned earlier, we did require in this product line, a couple of cycles to change some of our products, which took a little longer. So we would expect some ramp up, but not a major ramp up in the H2. We would expect some sales to come.
Okay. So when you see the major ramp up for the yellow pigment, sir? 23?
23, yes, 23 second half, sir. Like I said, any capex, it would be about 3 years to kind of, scale up, right? So gradually every year something should happen.
Okay.
I would count for yellow. Yeah. This year I would count as year one for the yellow pigment.
Yeah. And secondly, sir, in terms of the gross margin improvement which we had seen in this quarter, is it also because, as you said, the raw material prices had gone up, so you would be having some inventory stocking, low price inventory, and that is the reason you have seen the gross margin improvement, and broadly this gross margin improvement also should fade in the second quarter?
Yes, sir.
Okay. Thank you, sir.
Thank you very much. Next question is from the line of Abhijit Akella. Please go ahead.
Yeah, thank you so much, sir, for taking my questions. First, just on RICO, just a clarification. Can we expect on a full year basis that margins will be near normal levels, or the kind of losses that we've incurred in 1Q? Those, it's not possible to recover them over the life of the projects that we are executing. How should we think about margins going forward?
Hi, Abhijit. Nilkant here. So on the RICO front, yes, so Q1 has been a difficult quarter, but overall the projection of the RICO management and based on the current order balance, we expect that they will make a turnaround, and by year end they will be able to get to the normal margin level, normalized margin level.
So just to clarify, sir, when you say by year end, are you saying on a full year basis, or you're saying that by 4Q the margin will start to approach normal levels?
So we expect that they will be able to come to the normal margin level on a full year basis.
Okay, understood. That's helpful. And second, just on the domestic revenues, we said that we expect normalcy to come, going forward. Should we expect that, 2Q will still be a little bit subdued given, the gradual recovery in the domestic market? It might take a few months. Plus, we had the Mahad incident also, which where we lost a couple of weeks. And so should we expect normalcy in domestic revenue run rate to come only from 3Q onwards?
Yeah, Abhijit, yes, so we expect that it will get restored to the normalcy from Q3 onwards.
Okay, thank you so much. I'll come back in the queue. Thank you so much.
Thank you. Next question is from the line of Ashwini Agarwal from Ashmore Investments. Please go ahead.
Hi, just small follow-up to one of the earlier questions, and just thinking through your opening comments again. I'm still a little intrigued that despite a fall in operating revenue in the pigment business, your gross margin came in at a fairly strong level, notwithstanding the fact that raw material prices probably went up. You had additional costs given the restrictions on production arising from COVID and so on and so forth. I mean, I'm still not able to kind of square what we are seeing in gross margin in the first quarter with a very subdued outlook you're presenting. Is there something else that we are missing? Is there any one-off very profitable contract that helped you in Q1 from a gross margin perspective? What else is it?
So, Ashwini, I don't, it's not, I think there are two parts to it, right?
Yeah.
One is, the gross margin has improved, but however, indirect costs have increased a lot, right, in terms of logistics and some of your utilities, right, like coal, etc. So that has, so if you look at that, not helped the EBITDA margin, right? So there is nothing like a one-time profitable. This, I think, as we continue to see some of the cost increases, and this was just a play of inventory versus the cost increases, and that's where we are saying that we don't see us completely, we would not be able to, the same gross margin may not continue. That's where we are being a little cautious on that perspective.
Rajesh, I hear what you're saying. So let me flip it around. Is the gross margin also higher because of the mix change? You have a lower contribution from domestic sales. Is that also a reason why gross margin is optically higher?
The gross margin has improved over the period of time.
Correct.
This quarter, there is an additional inventory impact. That's what we are saying.
The raw material inventory impact.
Yeah. Yes.
Okay. No, because if I just zoom out and forget these quarters and all that, okay, for the last 3 years or so, the trajectory was that your gross margins were going up, but your EBITDA margin was flattish or down because you were investing in the business, right? There was higher R&D costs. You'd hired people in Europe and invested in sales and marketing. And the whole objective was that over a period of time, the increase in gross margin would feed through to the EBITDA level as well, correct? And and some of it we saw last year. Your EBITDA margins did improve significantly in fiscal 21 over, average of 18, 19, 20. So, should I say that medium term, and forget some COVID-related disruptions happened in 1Q, one understands that. In the medium term, that that narrative should still hold, right? Say 2-3 years out, 2 years out, let's say March 24, if we think about, would it be reasonable for us to aspire for something like a 17-18% EBITDA margin?
So I would not like to quote a number, but Ashwini, the whole idea of transforming the business was that, right? That we change our product mix, we reach out to more global customers, and that's the narrative I would say is still continuing, and that's what our basis of our strategy is, right? This, like you said, if you zoom into a quarter, there are several issues on what you are aware, global issues, like logistics costs, coal costs, which were not anticipated at all, right, to have such a large impact. So I would still we would be still confident on the perspective of what we are saying. In addition to that, Ashwini, I would add one more factor that because of these 2-3 lockdowns and issues of COVID, our capex has got delayed considerably, right? Both
Correct.
in terms of implemental and none of the equipment suppliers could travel from abroad yet. So we have to commission some of the things on our own.
How about all that's done now, Rajesh? I mean, if I again look through, I mean, of course, you've had a lot of air pockets over the last, 1.5 years, and and it's hats off to you guys. You've managed to commission the projects, you've managed to get everything online, and it's visible in your numbers. So directionally, I'm saying forget 1 quarter, 2 quarters, but directionally, if you look out 7-8 quarters, and like you said, that whatever capex you're implementing now will show up over the next 3 years. So, if I zoom forward 8 quarters from now, and we are looking at, let's say, the June 23 quarter results, we should aspire for structurally higher EBITDA margin and structurally higher gross margin because of the sales mix, because of the productivity gains, all of that. It should come through. There's nothing to say that structurally anything has changed. That would be a fair comment on my part. I'm not putting any numbers out there.
Yes, absolutely.
Okay, good. Thanks, and all the best.
Thank you. The next question is from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Thank you. Thanks for taking my question again. Just one clarification on the capex side. What is the total cash capex we are looking at this year? It was 38 crore, which was pending from the 600 crore, which we have planned earlier. So that's a cash capex. So what is the remaining cash capex we are looking at for this year, particularly from the cash outflow perspective, and what should we be the same in FY23?
Hi, Nilkant here. So I think you are referring to the 38 number which we presented in Q4, and that what we said is balance, correct? So there is some CWIP number which was there in March, and this particular 38, and there also has been the additional approval of 135 crore of capex, correct?
Correct.
Which we already stated in the earlier call. So we expect that the capex outflow will be to that extent will cover this balance as well as the new one. And we also say that CWIP, there is also capital creditor, correct, on the other side. So some part of the CWIP will also get paid out in this year.
Got it. So basically 35 plus 135 plus some payout of the CWIP which is sitting in the capex creditor will be the total cash outflow for this year. How should we see for next year?
So next year, what we expect is majority of this capex, which we have already stated, will get commissioned by Q3. I don't expect the cash flow spillover from this major capex. Out of 135 crore, since we have taken the approval now, there might be 20-25% of cash outflow, which might go to the next year. But this also depends on the current situation and the execution. But I don't expect it is more beyond 25%.
Got it. From the commissioning perspective, last time we said that this 135 crore is largely to build the infrastructure and utility, and also the 38 crore was only the commissioning part of it which was pending. It was fairly small capex to the quantum of capex we have been doing. Why are we talking that to be commissioned only in Q3? 38 was a very small number to complete the capex, given that a large amount of capex has been spent. What is causing such a small capex, such a large delay is what I was trying to understand.
So I think we need to see this from, we also need to consider the CWIP, correct, which was there in March, 269 crore plus 38 balance to complete. So we are looking at 300 plus crore of number, which will get executed in this year. Out of this, we are expecting 120 crore of, capitalization by H1, that is September, and balance will happen in Q3. That is what we have said.
No, that I understood. Sir, just my question is, CWIP means we have already incurred the capex, but it has not commissioned. That means the capex has been incurred, the machinery and whatever the things are ready to go. The remaining balance 38 is to be executed. That 38 crore out of the 307 crore what was pending, and just this 38 crore is holding up this 307 crores of commissioning. I just wanted to understand why this small amount of 38 crores of capex execution is taking the 3/4 of a time.
So, fair point, but we also have to understand that this CWIP, which we already mentioned, has been in the various stage of project execution, correct? And that's the reason that we said that it will happen in Q2 and Q3. So that is the way we look at it.
Great. So 120 by Q3 and remaining by Q4 is what we are expecting. This 307 should be completely commissioned by end of this fiscal year.
Yes, sir. Yes, sir.
Yeah, thank you. Thank you very much.
Thank you. Next question is from the line of Elroy Lobo from Kotak Investment Advisors. Please go ahead.
Yeah, thanks for giving me an opportunity to ask questions. My first question is to understand the sales and distribution infrastructure you have built internationally, and how are the sales people really incentivized for demand creation? And that's one. And second is, if you can just comment on how easy it is for customers to switch, vendors when they are used to a particular vendor for a particular, pigment or a product.
So, two questions, I think. So, first question is the product. Our product is very sensitive to application. So, there's a lot of rigor in application testing, right? Even our R&D has this application lab where the product gets tested either for cosmetic, paints, or plastic. So, it's not a percentage like a caustic soda, which is like a bottom percentage purity. Each industry has a different time limit. Coating, cosmetics coatings being the highest and printing being the lowest. In terms of sales, every geography has a different this, but there is a fixed portion and a variable portion. As we have recruited these people from very reputed companies, and they carry a higher reputation.
So my question is, how do you evaluate whether those investments are really paying off? Are there any kind of, metrics that you use, the sales per salesperson that you have recruited? Is there, any constraints you will face even after the capex is implemented, for you to actually get customers to, buy your product, because switching costs for some of these customers may not warrant it. So I just wanted to understand, from the capex stage to the, sales stage, is there any challenge that you will face going forward?
Your voice is breaking. I couldn't follow your question on the second. I understood the first set of questions, but this I didn't understand the clarification.
Yeah. See, the point I'm trying to make is that once you set up CapEx, the general assumption is that you will get sales by utilizing your capacity. But I just wanted to, understand, is there any challenge to convert, your CapEx into actually, sales output? Because maybe customers, take time to approve or for that matter even switch, from an existing vendor. So do you see any challenges, once your CapEx is in place to actually generate the sales on the CapEx?
So yeah, very well. Absolutely well put, and that's why we're saying that we will take at least 3 years for a capex to get utilized, to get fully this. And customers do. Generally, the customers do a good technical evaluation. The only way we prepare for this is we seed customers with some of our pilot plant samples, etc., where we do get some feedback from them, some of the leading customers, and that's how we commercialize the product, and hoping that timeline now would be that the product will be successful. So that's how we arrange ourselves.
And do you have any benchmarks on the sales that your salesperson should derive? Is there a kind of a revenue per salesperson that you target? From an incentivization perspective?
So it depends on the geography. So what we have usually as a matrix is sales, the contribution margin generated by the sales, the opportunity funnel of the person, and geography to geography, of course, we track salesperson, sales per person, etc.
So how many sales people have you recruited internationally, and what is the cost of that sales force right now?
We can't, this in the public. We are not right now giving that. We'll check whether this information. I won't have it hands off. We'll check whether we will check whether we can give.
Well, maybe not the cost, but at least the number of people that are in sales overseas. Totally we have more than 55 to 60 sales people. Okay. Thank you.
Thank you very much. Next question is from the line of Kush Tandon from Anta Capital. Please go ahead.
Thanks for the opportunity, sir. Sir, I'm just trying to understand one thing. If I see your last 9 quarters of pigment revenue, I see the entire FY24 quarters was around 400 crores, 396, 400, 391, 402. Then Q1 FY21 we had COVID impact, so we went down to 340. Then again Q2 was 400. So sir, we were basically trending around 400 crores per quarter kind of a pigment number. And we did around 270 crore of capex in FY20. So sir, the jump in Q3, Q4 to 477 crore and 532 crore of revenue in the pigment business, is it fair to say, sir, that this jump from 400 to 477 and 532 and now to 453 from 400 each is because of the capex coming online? Is that a fair way to model in our minds the business?
Hi, Nilkant here. So, fair point, sir. So, and thanks a lot for this analytics. So, whatever 400 crore average quarterly sales which we have seen in the past years, now are trending to 450, 470 kind of turnover. Yes, so this has been also the factor which has given us strong FY20 capitalization. So, the capitalization which we have done in the FY20 is helping us to get this growth in the sales number.
Okay.
And it is a still ramp up.
Okay. So, understood. So, let's say 400, I'm sure it can, the products, there can be here and there, but broadly speaking, we can conclude that probably 400 crore was a stable run rate, and whatever incremental capex is coming online is adding to the incremental revenues. And in 3 years, whatever capex you did in FY20 the revenue will be 2x of that capex in the third year. Is that a fair way to model this business?
I'm Wilkand here. So, fair point, sir, but what we expect is, we had already mentioned in our presentation earlier, saying that we expect this additional capex to give us 1,200,000 to 1,200 crore of additional revenue. And majority of the capex which we implemented or started the capex capitalization from FY20. So you can take from FY20 base this additional incremental revenue for your modeling, the next 3 years, for the next 3 years.
Thank you very much. Ladies and gentlemen, that will be the last question for today. I will now hand the conference over to the management for closing comments.
Thank you, Abhijit. Thank you, participants, for your time and interest in Sudarshan Chemical. We remain confident on the long-term prospects of our business, and we look forward to engaging with you again. Thank you. Stay safe.